Francis Hunt just issued a warning that changes everything. The gold to silver ratio, the one number that's been distorted for decades, is now collapsing. And when it reaches single digits, silver won't stop at $300 or even $500. Hunt is calculating 4-digit prices in a currency system that may not even exist as we know it today. 60 to 70% of the world's silver supply comes from mines that aren't even looking for silver. The electric vehicle revolution alone could consume 100% of current production, which means everything else gets cut off. The contagion phase has begun, and most investors will realize it far too late. Welcome to Currency Analyzer, where we don't just report the news, we decode the financial architecture being built while you sleep. Now, I need a small favor from our experienced viewers. You know, the ones who remember when a handshake meant something, when agreements were written on paper, not screens. If this analysis resonates with your years of market wisdom, would you honor us by pressing that subscribe button? It's right there below the video. Just one click. Consider it your vote of confidence and truth over noise. And please, drop a comment telling us where you're watching from today. Are you in the United States, watching silver miners operate in your own backyard? Perhaps you're in Europe, where monetary policy experiments are reshaping everything, or maybe you're in Asia, where physical metal ownership never lost its cultural significance. We want to know, where are the serious investors gathering today? Now, let's proceed to what Francis Hunt actually discovered. Francis Hunt sat in front of his trading screens one morning and noticed something that made him pause. The gold to silver ratio, a number that had been ignored by most investors for years, was beginning to move in a way he had only seen once before in his career. Not slowly, not gradually, but with the kind of momentum that signals something massive is coming. Hunt has spent decades analyzing precious metals markets. He has watched patterns emerge, patterns collapse, and patterns that most analysts miss entirely because they are looking at the wrong time frames. But this time, the signal was unmistakable. The ratio between gold and silver had reached 126 to 1, meaning it took 126 ounces of silver to buy a single ounce of gold. Hunt knew this number was historically absurd. He pulled up charts dating back centuries. In ancient Egypt, the ratio stood at 8 to 1, 8 ounces of silver for 1 ounce of gold. During the pre-Vietnam era, the ratio ranged between 10 to 1 and 15 to 1. These were the natural ranges when markets functioned without extreme financial engineering. But then, something changed. The world entered what Hunt calls the financialization era, starting around 2007 and accelerating ever since. During this period, silver was systematically suppressed. Not by conspiracy, but by market structure. Paper contracts multiplied, derivative products expanded, and the physical metal became disconnected from its price. The ratio climbed higher and higher, 30 to 1, 50 to 1, eventually reaching levels that defied economic logic. Hunt identified a critical technical pattern on his charts, a macro head and shoulders formation, the kind of pattern that appears once in a generation. The key level was 65. If the ratio broke below 65, it would trigger what technical analysts call a contagion phase. And it did. The ratio smashed through 65. Then continued falling with accelerating momentum. Hunt calculated the next target using his decades of pattern recognition, 32 to 1, but he didn't stop there. He told his followers something that shocked even experienced precious metals investors. The ratio could return to single digits. Not might, not possibly, but could with a probability higher than the current market price suggests. Why does this matter? Because when the ratio compresses, silver doesn't rise slowly, it explodes. But Hunt discovered something even more concerning when he examined the supply side, something that most investors have never considered. 60 to 70% of the world's silver doesn't come from silver mines. It comes as a byproduct from copper mines, zinc mines, gold mines, iron ore operations. Miners dig for other metals, and silver just happens to come along for the ride. This means only 30 to 40% of global silver supply comes from operations specifically designed to extract silver. Think about what this means. If silver prices rise, most producers won't increase silver production because they are not in the business of mining silver. They are mining copper. They are mining zinc. They are extracting gold. Silver is just the bonus, the afterthought, the waste product that happens to have value. A copper miner doesn't care if silver reaches $100 or $200. He is focused on copper prices, copper demand, copper extraction costs. The silver that comes with it is merely sold off, whatever the market offers. This creates a supply structure that cannot respond to price signals. The normal laws of supply and demand are broken. When gold prices rise, gold miners expand operations, they open new mines, they invest in exploration, they increase production. But silver supply remains largely fixed, locked into the production schedules of mines targeting other metals. Hunt also noted another critical factor. Above-ground silver inventory has been depleting for years. The massive stockpiles that existed decades ago, when silver was used in photography and coins and applications that have now disappeared, those stockpiles are largely gone. They were sold off during the suppression years, melted down, consumed by industry, never to return. What remains is a market structure where demand is rising, supply cannot respond. And the ratio between gold and silver is breaking down after decades of distortion. Hunt designated this phase with a specific term, contagion. In market analysis, contagion means a move has transitioned from gradual adjustment to accelerating momentum, where technical signals and fundamental forces align, and prices begin moving in ways that defy conventional forecasting models. The ratio breaking below 65 was not just a technical event, it was the trigger. And for investors holding silver or considering silver, the question Hunt posed was simple but profound. If silver reaches $200, will $82 today seem expensive? Or will it seem like the opportunity that defined a generation? The contagion phase had begun, and most investors had not even noticed yet. Hunt opened a chart that most investors would never bother to examine. A quarterly price chart for silver, stretching all the way back to the 1950s. 70 years of data, condensed into a single visual framework. He did not open this chart to impress anyone. He opened it because this time frame reveals patterns that shorter charts cannot capture. And what he saw was textbook market compression. Imagine a coiled spring. The longer it compresses, the more energy it stores. And when it finally releases, the movement is violent and unstoppable. Silver had been compressing for decades. Hunt pointed to a specific formation on this massive time frame, what he called a squeeze within a squeeze, two layers of volatility compression happening simultaneously. The first squeeze was visible on the macro level, decades of price suppression creating an enormous pressure buildup. But inside that larger pattern, a second, tighter squeeze had formed more recently. When this happens in market analysis, the subsequent breakout is rarely modest. It is almost always explosive. Hunt did not rely on hope or speculation. He used a methodology he developed over years of studying parabolic market moves. He calls it the HVF method, high value forecast. The details of this method are proprietary, but the output is public. His first major target, $333 per ounce. But here's where Hunt differentiated himself from typical analysts. He did not present 333 as the peak. He presented it as a resting point, a consolidation zone, a place where silver would pause, catch its breath, before continuing higher. Most investors misunderstand how parabolic markets function. They assume prices rise in steady, predictable increments. But Hunt has studied gold in the 1970s. He has studied Bitcoin in 2017. He has studied every major parabolic asset move in modern market history. And they all follow the same law, the law of the parabola. This law states something that sounds impossible until you witness it. 50% of your total gains occur in the final 5 to 10% of the cycle. Read that again. Half of all profits. In the last few percentage points of the move, this is why most investors exit too early. They watch silver climb from $80 to $150. They feel smart. They take profits. They congratulate themselves on a successful trade. And then they watch from the sidelines as silver rockets from 150 to 600 in a matter of weeks. They captured 30% of the move and missed the 70% that mattered most. Hunt was adamant about this point. You might plan to sell at 333, but if you're not psychologically prepared for silver to overshoot to $1,500 or $2,000, you will sell at exactly the wrong time. Because markets do not stop at rational levels, especially not in the late stages of a cycle. They overreact violently in the opposite direction of the previous suppression. For decades, silver was called worthless by mainstream analysts, a relic, an industrial metal with no monetary future. But when perception shifts, when the crowd suddenly decides silver is essential, the pendulum does not swing to neutral. It swings to extreme. Hunt described this as the God money phase, when investors stop analyzing and start panicking, not panic selling, panic buying. They will pay any price because they believe there will be no price high enough tomorrow. This is the environment where 333 becomes 1,500, where rational targets become irrelevant and emotional momentum takes over. But Hunt also warned about something crucial. The path to these levels will not be smooth. Silver will experience violent pullbacks, even during a raging bull market. He showed his followers an example from recent history, when Bitcoin, gold, and silver all appeared to top out simultaneously. The financial media declared the rally over. Analysts published reports calling it the peak, and most retail investors sold in fear. But Hunt saw something different. He saw a gift, a pullback on the daily time frame, inside a macro bull trend on the quarterly time frame. He entered 2 positions during that pullback, with tight stop losses placed at what he called the relative lows, levels where, if broken, would invalidate the bullish structure. Those stops were never hit. Instead, silver rallied 150 points from his entry, then another 150 points, now sitting 305 points higher with locked-in profits. This is what he meant by gifts within gifts. The market loves to reward those who understand its structure, but only if they are watching the right time frames. Most investors stare at hourly charts, getting shaken up by noise, missing the macro trend entirely. Hunt operates differently. He holds quarterly conviction, but executes on daily timeframes. This allows him to stay in long-term trends. While still managing risk on shorter cycles, he does not buy and forget. He buys, manages, adds on pullbacks, and scales out strategically. And this is the framework he believes will be essential in the coming silver move. Because when the contagion phase fully develops, volatility will become extreme. Emotions will run wild, and only those with a clear technical framework will survive intact. Hunt made one final point in this section. The gold to silver ratio returning to single digits is not a fantasy. It is a probability-weighted outcome based on historical precedent and current market structure. When the ratio hits 8-to-1 and gold is at $3,000, silver will be at $375, and that still won't be the top. Hunt was not concerned about investment demand alone. That was only part of the equation. What kept him awake at night was something far more concrete, something that could not be solved by printing more money or creating more paper contracts. Industrial demand, and not just any industrial demand, a structural shift in how the entire global economy was being rewired. He started with a simple example that anyone could understand. Electric vehicles. The world's governments had made a decision, a mandated transition away from internal combustion engines toward battery-powered transportation. Whether people agreed with this decision or not was irrelevant. The mandates were already in place. The timelines were already set. The infrastructure investments were already committed. And every single one of these vehicles required silver. Not a little silver. A lot of silver. Hunt explained the mathematics in a way that was impossible to ignore. New solid-state battery technology had achieved something remarkable. 900 kilometers of range on a single charge. Charging to 80% capacity in just 8 minutes. This was the breakthrough that would make electric vehicles practical for mass adoption. No more range anxiety. No more waiting hours at charging stations. But here was the problem. These advanced batteries required massive amounts of silver. Hunt laid out the calculation. If just 20% of new vehicles used this battery technology, it would consume 100% of current global silver production. 100%, not some, not most. All of it. Every ounce of silver currently mined each year, gone into batteries alone, which raised an obvious question. What about everything else? What about solar panels, which use silver in their photovoltaic cells? What about electronics? Smartphones, computers, tablets, servers, all of which require silver for their circuitry. What about defense systems, which use silver in high-temperature applications, missiles, radar systems, and advanced weaponry? What about medical equipment, industrial applications, and the thousands of other uses that depend on silver's unique properties? Hunt was not exaggerating. He was simply doing the math that no one else wanted to acknowledge. If electric vehicles alone consume all available silver, then every other sector gets cut off. Completely. There's no silver left for them. And this is where the supply problem becomes catastrophic. Because, unlike other commodities, silver supply cannot respond quickly to price increases. Remember what Hunt identified in Part 1? 60 to 70% of silver comes as a byproduct from mines targeting other metals. A copper miner in Chile is digging for copper. He is focused on copper prices, copper demand, copper extraction costs. If silver prices double, he does not suddenly dig more. He continues extracting copper at the same rate. And whatever silver comes along is simply a bonus. The same applies to zinc miners, gold miners, iron ore operations. They are not in the silver business. They are in the copper business, the zinc business, the gold business. Silver is just the leftover, the waste product that happens to have value. This means that even if silver prices rise to $200 or $300 or $500, total production will barely increase. Hunt pointed to another critical factor. Primary silver mining operations. The mines specifically designed to extract silver face enormous economic challenges. The energy cost of opening a new silver mine, the capital investment required, the years of exploration, permitting, and development. All of this has been economically unviable at suppressed silver prices. No company will spend hundreds of millions of dollars and wait 5 to 10 years to bring a mine into production. when silver prices have been artificially held down for decades. So new supply is not coming, not quickly enough to matter. And existing supply is locked into production schedules that cannot respond to demand shocks. Hunt then shifted to something even more disturbing, the monetary system itself. He did not know what form money would take in the coming years. Would it still be the physical dollar? Would it be a central bank digital currency? Would it be something else entirely? He acknowledged this uncertainty openly, but he made one point with absolute clarity. In old dollar terms, in the purchasing power equivalent of today's currency, silver will reach 4 digits, $4,000 or more. Not because silver becomes infinitely valuable, but because the currency unit itself becomes meaningless through excessive creation. When central banks have printed trillions upon trillions of currency units, when debt levels have reached levels that can never be repaid, when the entire financial system is built on confidence rather than tangible value, the numbers lose all connection to reality. Hunt was not predicting hyperinflation necessarily. He was predicting repricing, a repricing of physical assets against paper claims, a repricing of scarcity against abundance, a repricing of what can be created infinitely versus what cannot. And then there was the geopolitical layer. The surveillance grid that governments were constructing required silver, smart meters on every home, monitoring energy consumption in real time, smart appliances connected to centralized grids, allowing governments to control usage remotely, the removal of gas stoves, gas heating, gas infrastructure entirely, forcing populations onto electric grids that could be monitored and controlled. Every one of these systems required electronics, and electronics required silver. Hunt was not making a political statement. He was making an industrial observation. Agree or disagree with the surveillance state. It was being built, and it ran on silver. Defense contractors were also consuming silver at unprecedented rates. Advanced weapon systems, hypersonic missiles, electronic warfare technology. All of it required silver's unique conductivity and high temperature properties. Governments were not going to stop building these systems because silver was expensive. They would simply pay whatever price was necessary. Hunt arrived at a conclusion that was both simple and terrifying. Industrial demand alone would soon exceed total global production, before investment demand even entered the equation. This was not a supply shortage. This was a supply crisis with no solution except price rationing. And the market had not priced this reality in yet. Hunt paused before delivering his final assessment, because what he was about to explain would determine whether investors captured this opportunity or watched it pass by like so many others. He started with a question that cuts through all the noise. If silver is likely headed to $200 or higher, does $82 seem expensive? Most people cannot answer this question correctly because they are anchored to recent prices. They remember when silver was $25 or $30, and 82 feels high by comparison. But Hunt reminded them to shift perspective. Gold was once trading below $300 per ounce. Then it climbed to $800, then $1,200. Now it sits above $2,000. Anyone who thought gold was expensive at $1,200 missed the entire next phase of the bull market. They were right that it was higher than before, but they were wrong about what mattered. What mattered was not where it had been, but where it was going. Hunt applied the same logic to silver. At $82, with a high probability path to $200, $300, or higher, the current price is not expensive. It is compressed. It is the last moment before the spring releases. But he also acknowledged something crucial. Timing matters, not for the macro trend. The macro trend is clear, but for individual investors who need to manage risk, who need to sleep at night, who cannot afford to see their positions cut in half during a violent pullback. This is where Hunt's multi-time frame approach becomes essential. He holds quarterly conviction, meaning he believes the long-term trend is undeniably bullish, but he executes on daily and weekly timeframes, allowing him to enter on pullbacks, place tight stops, and protect capital if the structure breaks. He showed a recent example. When silver, gold, and Bitcoin all corrected sharply, the financial media declared the bull market over. Analysts published bearish reports. Retail investors sold in panic. But Hunt saw a gift, a normal pullback within a macro uptrend. He entered 2 positions during that decline, placed stop losses at the relative lows, the levels that, if broken, would invalidate the bullish structure. Those stops were never hit. Silver rallied 150 points, then another 150 points. Now, sitting over 300 points higher with profits locked in. This is the discipline required. Not buying blindly, not hoping prices go up, but waiting for technical setups, entering with defined risk, and managing positions as they develop. Hunt also addressed the most dangerous phase of the entire cycle, the overreaction. He called it the God money phase, when silver stops being analyzed and starts being worshipped, when investors stop asking if it is expensive and start buying at any price because they fear missing out. This phase is coming, not today, not tomorrow. But when the contagion phase fully matures, and when it arrives, silver will not stop at rational levels. It will overshoot dramatically. 333 will feel cheap, 500 will feel reasonable, 1,000 will seem justified, and 1,500 to 2,000 will become the new narrative. But Hunt warned his followers, this is also when discipline becomes nearly impossible to maintain, because every instinct will scream to hold, every article will predict $10,000 silver, every forum will be filled with people who claim they will never sell, and this is precisely when systematic selling must begin, not out of fear, but out of strategy. Hunt's exit framework is tied to the gold to silver ratio, not to fixed price targets. He watches the ratio as it compresses. When it reaches certain levels, he begins partial exits, usually around 50% of his position at consolidation zones, like 333. This allows him to lock in substantial gains, while still maintaining exposure if the move continues. If the ratio continues compressing toward single digits, he scales out further, taking profits systematically, never trying to pick the exact top. Because no one picks the exact top, and those who try usually end up giving back most of their gains. Hunt also emphasized something that many investors overlook: the difference between paper silver and physical silver. He repeated a principle that has been true throughout monetary history. If you do not hold it within the borders of your own country, in a safe that you control, you do not own it. This is not paranoia. This is recognition of counterparty risk. When systems are stressed, when currencies are in question, when governments are desperate, paper claims become worthless overnight. ETFs can be suspended. Exchanges can impose position limits. Brokers can freeze accounts. But physical metal in your possession cannot be taken by a margin call, cannot be frozen by a system error, cannot disappear because a counterparty failed. Hunt was clear about his own positioning. He holds physical silver, stored securely, within reach, not in some vault on another continent that he has never seen. And he recommended the same approach to anyone serious about wealth preservation. He also addressed a question many investors struggle with: should gold investors switch to silver? His answer was nuanced. Gold has its place as the ultimate monetary metal, the asset central banks hold, the metal that has preserved wealth for thousands of years. But silver offers something gold cannot: asymmetric upside potential. Because of the ratio distortion, because of the supply crisis, because of the industrial demand explosion, silver has the potential to outperform gold by multiples during this cycle. Not because gold will fall, but because silver will rise faster. Hunt's final point was the most important. This opportunity exists because of a rare alignment. Technical patterns that appear once in a generation, fundamental supply-demand imbalances that cannot be resolved quickly, and monetary system stress that makes hard assets essential. These three factors do not align often. And when they do, the window closes quickly. Right now, the window is open. The contagion phase has begun. But most investors have not recognized it yet. They are waiting for confirmation, waiting for the media to tell them it is safe, waiting for prices to rise further before they feel comfortable buying. And by the time they receive that confirmation, by the time the media is screaming about silver, by the time everyone feels comfortable, the opportunity will have already passed. And the only question remaining will be, why didn't I act when the signal was clear?